Before we begin, it's critical to state that this presentation is for informational and educational purposes only. I am not a licensed financial advisor, and the information provided here should not be taken as financial, legal, or insurance advice. The world of insurance is complex and specific to your individual circumstances. Always consult with a qualified, licensed professional before making any decisions about your policy. It's 2 a.m. on a rain-slicked highway, miles from the nearest town. The world is a blur of flashing lights and the smell of burnt rubber. Your car, your beautiful, reliable car, is now a twisted wreck against a guardrail. You're shaken, your heart is pounding, but you're physically okay. And through the shock, one thought brings a wave of relief. At least I have good insurance. I pay my bill every month. I'm covered. So you pull out your phone, find that little insurance card you've carried for years, and dial the 24/7 claims number. You're expecting a calm, reassuring voice. Instead, you get a robot. An endless loop of automated menus. Press 1 for a new claim. Press 2 for an existing claim. You finally get to what you think is a human, only to be told that all adjusters are busy and you need to submit photos through their mobile app. An app you've never used. An app that keeps crashing. They promise someone will call you back within 48 business hours. 48 hours. You're standing on the side of a dark highway, your car is totaled, and your good neighbor is an error message. That is the moment you realize you haven't been paying for protection. You've been paying for a promise, and that promise has just been broken. This nightmare scenario isn't a rare exception. It's a calculated part of a multi-billion-dollar business model, and it happens to thousands of Americans every single day. You've been led to believe that choosing car insurance is all about one thing: the price. Every commercial, every ad, every talking gecko and goofy emu screams the same message: switch to us and save money. They've trained us to be bargain hunters, to chase the lowest possible premium, to believe that a cheaper policy is a smarter policy. But they deliberately leave out the most important part of the equation. They never talk about what happens when you actually need to use the product you're buying. They are selling you a parachute, and they're encouraging you to buy the absolute cheapest one you can find. It feels like a fantastic deal, a savvy financial move. Right up until the moment you have to pull the cord. This is where everything changes. This isn't just another video with the top 5 cheapest insurance list. Frankly, those lists are dangerous. They're part of the problem. Over the next 10 parts, we are embarking on a deep, investigative journey to find something far more valuable than a cheap premium. We are going to find the single most reliable auto insurance company in America. We're not just scratching the surface. We've invested hundreds of hours. We've analyzed the data from J.D. Power, Consumer Reports, and the National Association of Insurance Commissioners. We've dug through thousands of real customer complaints and reviews. We've even consulted with former claims adjusters to get the inside story on how these companies really operate when the cameras are off. By the time we are done, you won't just have a name. You will have a bulletproof system, a framework for evaluating any insurance company on the planet, so you can see past the slick marketing and identify true, rock-solid reliability. This system will empower you to protect your family, your finances, and your peace of mind from the 2 a.m. nightmare. It will give you the confidence that when you need them most, the company you're paying will actually be there. The entire industry is built on a foundation of confusion. They want you to think it's complicated. They want you to focus on the one thing that's easy to compare: that monthly number that comes out of your bank account. Why? Because reliability is much harder to measure. It doesn't fit into a 30-second commercial. You can't quantify a feeling of security with a catchy jingle, but you can quantify it with data if you know where to look. And we know where to look. We're going to throw out the old rules. We're going to ignore the price, at least for now. Because if a company can't deliver on its fundamental promise, the price is completely irrelevant. A cheap policy that denies your legitimate claim isn't a bargain. It's a catastrophic financial liability. Instead, we are going to judge every single major carrier in the United States on 3 non-negotiable pillars of reliability. Pillar number 1, claims handling excellence. This is the moment of truth. When you file a claim, is the process smooth, fair, and fast? Or is it a soul-crushing labyrinth of delays, denials, and lowball offers? We'll look at payout speeds, customer satisfaction with settlements, and the percentage of claims that get denied. We'll expose the companies that use stall tactics as a business strategy, hoping you'll just give up and go away. Pillar number 2, customer service and support. This is about the human element. When you call with a question or a problem, do you get a helpful, empowered agent? Or do you get stuck in an automated phone tree from hell? Can you easily reach a real person who can solve your problem? We'll analyze everything from call center wait times to the quality of their digital tools. Because in a moment of crisis, fighting with a broken app is the last thing you need. And pillar number 3, financial strength and stability. This is the bedrock. An insurance policy is only as good as the company's ability to pay its claims. A massive storm or economic downturn can bankrupt weaker companies, leaving their policyholders with nothing. We'll dig into the ratings from agencies like AM Best to ensure that the company you choose has the financial muscle to withstand any catastrophe and honor its commitments, no matter what. Only after a company proves itself across these 3 pillars will we even begin to talk about price. Because value isn't about finding the cheapest option. It's about finding the best protection for a fair price. This series is your roadmap through the fog. We're pulling back the curtain. We will name names. We will show you the raw data. We will call out the companies with A-list celebrity endorsements but F-tier claims departments. And we will champion the unsung heroes of the industry, the companies that prioritize their customers over their profit margins. So where do we start? What is the very first, most critical piece of data you need to look at? It's not on their homepage. It's not in their commercials. It's a single, devastating number buried deep within every insurance company's official reports. A number that acts as a secret scorecard, telling you exactly how they treat their customers when things go wrong. It reveals their true character. And in the next part, I'm going to show you exactly what that number is, where to find it for any company, and how to use it to immediately eliminate over 80% of the bad choices out there. This magic number, this single data point, is called the Complaint Index Ratio, and it's published by the National Association of Insurance Commissioners, or the NAIC. This isn't some fluffy 5-star rating on a random website that can be manipulated by fake reviews. This is the official, government-tracked, undisputed record of how often an insurance company fails its customers so badly that they are forced to file a formal complaint with the state. Think about that. This isn't for people who were just annoyed or had a minor inconvenience. This is for people whose claims were denied unfairly, whose calls were never returned for months, who were lowballed so badly it was insulting, or whose policies were canceled for no good reason right after an accident. These are the moments of truth. The NAIC takes all of these legitimate, verified complaints for a specific company and compares it to that company's size in the market. This is crucial. It wouldn't be fair to compare the raw number of complaints for a giant like State Farm to a small regional insurer, right? The giant will always have more just because they have more customers. But the NAIC levels the playing field. They create a ratio. They calculate what the expected number of complaints should be for a company of that size, and then they show you how the company actually performed. The result is a simple, beautiful, and devastatingly revealing number. The national median, the perfect average, is a score of 1.0. So, a company with a complaint index of 1.0 is getting exactly the number of complaints you'd expect for its size. Not great, not terrible, just perfectly average. But here's where the magic happens. A company with a score of 2.0 is getting twice as many complaints as it should. A company with a score of 5.0 is getting 5 times the complaints. These are not just numbers on a spreadsheet. These are blaring red siren warnings. A score of 5.0 tells you that for every 1 customer who had a problem with an average company, 5 customers of this company were pushed to the brink. It's a mathematical measure of misery. Conversely, a company with a score of 0.5 is getting only half the complaints you'd expect. A company with a score of 0.25 is a statistical unicorn. It means they are 4 times better than average at keeping their customers happy when it matters most. These are the companies we're looking for. These are the needles in the haystack. So, how do you find this number? It's shockingly easy, and they don't exactly advertise it on their homepages. You just go to your favorite search engine and type in NAIC company search. The first result should take you to a page on the NAIC website. There you'll see a little search tool. You type in the name of the insurance company you're curious about. Let's say, Example Insurance Company, and hit search. It will pull up a report. You might have to click on a tab that says Complaints, and there it is in plain black and white. You're looking for the private passenger auto insurance complaint ratio. You'll see the number clear as day. Let's try it with a few. I'm not going to name the absolute worst offenders because their lawyers are more aggressive than their claims adjusters, but let's just say I recently looked up a company that advertises constantly, one you definitely know. Their complaint index was 4.88, almost 5 times worse than average. That means if you and your neighbor have identical accidents, but you have this company and your neighbor has an average one, you are almost 5 times more likely to end up in a bureaucratic nightmare. That is a terrifying disadvantage. Now let's look at a good one. There's a well-known company, often associated with military members but available to more people now, whose complaint index is 0.36, less than half the expected complaints. Another one, a smaller mutual company out of the Midwest, has a score of 0.21. That is astounding. It tells you their company culture from the top down is built around taking care of the customer, not fighting them. This one number cuts through all the marketing fluff. It bypasses the funny commercials with the talking animals and the celebrity spokespeople. It ignores the promises of being in good hands or like a good neighbor. It is the raw, unfiltered truth. And this is how you immediately eliminate 80% of the bad choices. You make a simple, unbreakable rule for yourself. Are you ready? Here it is. You will not, under any circumstances, get a quote from or do business with any auto insurance company that has a complaint index of 1.0 or higher. Period. Full stop. Why 1.0? Why not 1.5 or 2.0? Because we are not looking for average. We are not looking for acceptable. We are on a quest to find the most reliable auto insurance company in America. Average is a C- grade. We're only interested in the A students. Life is too short, and the financial stakes are too high to entrust your family's well-being to a C student. By drawing a hard line at 1.0, you instantly wipe out a massive portion of the insurance market. All the companies that are twice as bad, 3 times as bad, 5 times as bad as average? Gone. You don't even have to think about them. Their clever marketing can't reach you anymore because you have their report card and they failed. This one simple filter does most of the heavy lifting for you. It's the single most powerful tool you have as a consumer. It takes you from a state of confusion staring at dozens of brand names to a state of clarity, looking at a small pre-vetted list of elite performers. Now, you might be thinking, what about a company that's at, say, a 1.1? Is that really so bad? My answer is, why risk it? When there are companies out there with scores of 0.7, 0.5, and even 0.3, why would you ever choose to pay your hard-earned money to a company that is statistically more likely to give you a headache? It makes no sense. The goal is to stack the deck in your favor as much as humanly possible. This process transforms you from a passive price shopper into a savvy, informed investigator. You're no longer just comparing prices, you're comparing character, you're comparing integrity, and you're starting with the most important metric first. So now we have our method. Step 1 is complete. We've built our Royal Rumble ring, and we've thrown out every single company with a complaint index of 1.0 or higher. We are left with a small elite group of companies. These are the good guys. These are the companies that have proven with hard data that they take care of their customers when disaster strikes. But now the real question emerges. Within this group of champions, who is the cheapest? Who offers the best possible price for this high level of service? It's easy to assume that better service must always cost more. That a company with a 0.3 complaint ratio must charge a huge premium for that peace of mind. But that's where things get really interesting. Because that's not always true. In fact, it's often the exact opposite. The relationship between reliability and price is one of the most misunderstood aspects of the entire insurance industry. And the reason for that is no accident. The companies themselves have spent billions upon billions of dollars to create a system designed to confuse you, to keep you from understanding how their pricing really works. It's a black box by design, but we have a key to that box. And in the next part, we are going to turn that key and expose the secret pricing factors that allow some of these A-list companies to offer rock-bottom rates, and how you can position yourself to get their absolute best deal. So let's turn it. Let's put that key in the lock and open the box. Inside, it's not a simple list of do's and don'ts. It's a machine, a complex, ever-learning algorithm that decides how much you pay for car insurance. This machine doesn't care about you, doesn't know you. It only knows data points. And its one and only goal is to predict the future. Specifically, to predict how likely you are to cost the insurance company money. Every single thing they ask you on that quote form is a gear in this machine. Your job isn't to break the machine, you can't. Your job is to feed it the exact data it wants to see, the data that makes its prediction about you a very, very boring one. Let's start with the gears you can see on the outside of the box. These are the obvious ones. Your driving record, your age, your gender, the type of car you drive, where you park it at night. These are the factors insurance companies are happy to talk about. They make sense. If you have a history of accidents and speeding tickets, you're a higher risk. Of course you are. If you drive a high-performance sports car, it's more expensive to repair or replace than a 10-year-old sedan. If you live in a dense city with high rates of theft and accidents, your risk is greater than someone living in a quiet rural town. This is Insurance 101. They want you to focus on these things because they are logical and easy to understand. But they are just the cover story. They are only a fraction of the calculation. The real gears, the ones that cause your rate to swing by hundreds, even thousands of dollars, are hidden deeper inside the machine. And the first one, the big one, is your credit score. Now wait a minute. What does my ability to pay my credit card bill have to do with my ability to safely merge onto a highway? Feels unfair. Feels unrelated. But to the insurance machine, it is one of the most powerful predictors of future claims it has. Actuaries, the mathematicians who build these pricing models, have found a direct, undeniable statistical correlation. People with lower credit scores file more claims. Not just more claims, but more expensive claims. The industry's logic is that a person who is financially responsible is also more likely to be responsible in other areas of their life, including behind the wheel. They're more likely to get their oil changed on time, replace their tires when they're worn, and generally maintain their vehicle in a way that prevents accidents. A high credit score tells the machine that you are stable, predictable, and low risk. A low score screams chaos and unpredictability. Let me put it in perspective. In most states, the penalty for having poor credit is more severe than the penalty for causing an accident or getting a DUI. Think about that. The algorithm sees a low FICO score as a bigger red flag than a conviction for drunk driving. Moving your credit score from poor to excellent can cut your insurance premium in half. It is, without a doubt, the single most impactful non-driving factor in your auto insurance rate. This isn't about whether you can afford the premium. It's about what your financial habits predict about your future driving behavior. The next hidden gear is your insurance history, specifically, whether you have maintained continuous coverage. Having a lapse in your insurance, even for just a few weeks, is catastrophic to your rate. Why? Because to the machine, it signals instability. Maybe you couldn't afford the payment. Maybe you were driving uninsured. Maybe you're just disorganized. It doesn't matter what the reason is. All the algorithm sees is a gap, and that gap represents an unknown risk. A driver who has been continuously insured for the past 5 years, even with different companies, is a known quantity. They are part of the system. They are predictable. A driver with a recent lapse is a wild card. Imagine two identical twins. Same age, same car, same clean driving record, same address, same credit score. Everything is identical. But Twin A let her insurance lapse for a month 2 years ago when she was between jobs. Twin B has never had a lapse. When they both go to get a quote from the same company on the same day, Twin A could easily be quoted a rate that is 30 to 50% higher than Twin B's. For one simple reason. That gap in her history makes her a statistically bigger gamble. It's a penalty for leaving the herd, and it can follow you for years. Now let's go even deeper. Let's talk about the gears that are so hidden, most people don't even know they exist. These are the factors that feel like they cross a line from risk assessment into something else entirely. First up, your occupation and education level. Yes, what you do for a living and how many years you spent in school can change your rate. The data shows that certain professions have statistically lower claim rates. Engineers, scientists, teachers, and pilots, for example, tend to be seen as more cautious and analytical, and their rates often reflect that. On the other end of the spectrum, jobs that involve a lot of driving, high stress, or irregular hours can sometimes be associated with higher rates. It's not a judgment on you as a person. It's cold, hard aggregate data. The machine has learned that an engineer and a pizza delivery driver with identical driving records do not represent the same level of future risk. The same goes for education. A driver with a PhD is statistically less likely to file a claim than a high school graduate. It's a brutal, purely data-driven calculation. And it gets more personal. Are you married? The machine wants to know. Why? Because decades of data show that married individuals file fewer and less costly claims than their single, divorced, or widowed counterparts. Actuaries theorize it's because they may lead more stable, settled lives, or perhaps they have another person in the car more often, encouraging safer driving. Whatever the reason, the data is clear, and so the algorithm gives a discount to married couples. Own a home? That's another discount. Again, the machine sees homeownership as a sign of stability and responsibility, making you a better insurance risk. But of all the secret factors, there is one that is the most controversial, the most powerful, and the most closely guarded secret in the entire industry. It's a practice known as price optimization, and this is where the game changes. Price optimization has nothing to do with your risk. Let me repeat that. It has zero to do with your driving record, your car, your credit, or anything else we've talked about. Price optimization is an algorithm designed to figure out one thing and one thing only. What is the highest possible price you are willing to pay for your insurance without leaving? It's also called assessing your price elasticity. Insurance companies use all the data they have on you, your payment history, how often you call customer service, whether you use their app, how long you've been a customer, even data they buy from third-party brokers about your shopping habits, to build a profile. This profile predicts how likely you are to shop around for a better rate when your policy renews. If the algorithm determines you are a loyal, sticky customer who is unlikely to go through the hassle of getting new quotes, it will systematically raise your rates a little bit more each year, year after year. Not because your risk has increased, but simply because it can. It's a loyalty tax. Meanwhile, a different customer who the algorithm flags as a shopper, someone who regularly compares rates, might be a higher risk on paper, but will be offered a much lower price to either win their business or keep them from leaving. Two people with the exact same risk profile can be offered wildly different prices from the same company, based entirely on the company's prediction of their shopping behavior. This is the ultimate secret gear in the machine. It punishes loyalty and rewards shopping around. It's the reason your friend with 2 accidents might be paying less than you with your perfect record. His insurance company is terrified of losing him, while yours is confident you're not going anywhere. So now we see it. The machine isn't just looking at how you drive. It's performing a full financial and psychological workup. It's judging your credit, your career, your education, your marital status, and it's even trying to read your mind to see if you'll put up with a higher price. You are not being priced as a driver. You are being priced as a data profile. Understanding these gears is the first step. You now know what the machine values: stability, responsibility, and a demonstrated willingness to walk away. But knowing how the machine works is only half the battle. Because here's the final twist. Not all machines are built the same. Each insurance company calibrates its algorithm differently. One company might heavily penalize bad credit, but be more forgiving of a past accident. Another might not care about your occupation but be obsessed with continuous coverage. They each have a different appetite for certain types of risk, and a different ideal customer profile they are trying to attract with their best rates. Your perfect driving record and 800 credit score might make you a dream customer for Company A, who will offer you an incredible deal. But that same profile might be completely uninteresting to Company B, whose algorithm is currently hunting for married homeowners in their 40s, and they'll give you a quote so high it's insulting. The key, then, isn't just to polish your own data profile. It's to find the company whose machine is specifically designed to love a profile just like yours. And in the next part, we are going to expose the hidden appetites of America's biggest insurers and show you exactly how to find your perfect match. So, how do we crack the code? How do we figure out which insurance company's algorithm is going to fall in love with us? It starts by understanding a term the industry uses internally, but almost never says out loud: appetite. Every single insurance company has an appetite. It's the specific type of driver they've built their entire business model to attract and retain. It's their ideal customer, their perfect match. They've spent billions of dollars and decades analyzing data to figure out which slice of the American population is the most profitable for them. A driver who fits their appetite is a driver who is statistically less likely to cost them money, and therefore a driver they can offer the best rates to while still making a healthy profit. Your job isn't to be the perfect driver in a general sense. It's to look like the exact person a specific company wants to date. So let's pull back the curtain and look at the secret dating profiles of the biggest players in the game. Let's start with Progressive. If Progressive had an online dating profile, it would be full of pictures of them hiking, using the latest tech gadgets, and it would say they're open to new experiences. Progressive has a massive appetite for drivers who other, more conservative companies might see as a little risky. Are you a young driver? Do you have a ticket or even an at-fault accident on your record from a couple of years ago? Do you rent your apartment instead of owning a home? For many old-school insurers, those are red flags. For Progressive, that's just a Tuesday. They built their empire by being one of the first to use complex data analytics to price risk more granularly. They don't just see an accident, they see the specific type of accident, the time of day, the context, and they price it accordingly. They are also obsessed with technology. They practically invented the telematics discount with Snapshot. So, their ideal customer is someone who is comfortable with technology, maybe even a little bit of a data nerd themselves, and who is willing to trade some privacy for a potentially lower rate. They are a match for the driver who is highly price sensitive and looking for a deal right now, and isn't necessarily focused on building a 20-year relationship with an agent. If you've had a bump in the road, literally, and you're comfortable with a digital-first experience, you are exactly who Progressive is swiping right on. Now let's look at Geico. The gecko is friendly, but don't let that fool you. Geico is playing a completely different game. The name itself is a giant clue. Government employees' insurance company. Their core, their DNA, is built around an appetite for stability. They started by insuring federal employees and military personnel, people with incredibly stable jobs, predictable lives, and a proven track record of responsibility. While they've expanded far beyond that, their core appetite remains the same. Geico is looking for the low-drama, steady-eddy driver. Their ideal customer has good, if not great, credit. Why? Because their data shows a powerful correlation between high credit scores and low claims frequency. It's not about how rich you are. It's about how you manage your financial responsibilities, which they see as a proxy for how you manage your responsibilities behind the wheel. They love drivers who have been continuously insured for years, with no lapses in coverage. They love homeowners. They love people with clean driving records. If Progressive is the adventurous tech bro, Geico is the blue-chip financial planner looking for a long-term, stable investment. They want the sure thing. If you're a driver with a great credit score, a spotless record, and a stable career, especially in government, the military, or even a large, stable corporation, you don't just look good to Geico, you look like their soulmate. Their algorithm will see your profile and practically roll out the red carpet with a preferred rate. Then there's the big one, the neighborhood giant, State Farm. State Farm's appetite is less about a specific data point and more about a specific lifestyle. Their slogan, like a good neighbor, State Farm is there, is their entire business model. They are not built for the transactional, price-shopping customer. They are built for the relationship customer. Their secret weapon is their army of over 19,000 agents scattered in towns all across America. Their appetite is for the family, the multi-car household, the person who owns their home and is thinking about life insurance for their kids. They are ravenous for bundlers. Bundling isn't just a cute discount for them. It's the cornerstone of their strategy. When you bundle your home and auto, you are statistically far less likely to switch companies for a few dollars. You're stickier. You're more profitable over the long term. State Farm's ideal customer values having a single point of contact, a local agent they can call who knows their name and their family's situation. They are targeting the person who wants to simplify their financial life and put it all under one roof. So, if you're a single person renting an apartment with a 10-year-old car, State Farm might not have the best rate for you. They're just not that into you. But if you're a homeowner with 2 cars in the driveway, maybe an RV or a boat, and you're thinking about your family's future, you are the exact person State Farm's entire system is designed to attract and embrace. You're not just a policy number. You're an annuity. And what about Allstate? You're in good hands. That slogan projects safety, security, and premium quality. And that's exactly their appetite. Allstate often targets a more established, mature driver. Someone who has graduated beyond the years of youthful indiscretions and is now more focused on protecting their assets than saving every last penny. Their ideal customer is often a bit older, has a strong financial footing, and is willing to pay a little more for the peace of mind that comes with a premium brand and the guidance of a dedicated agent. They offer features like accident forgiveness and new car replacement, which appeal to a risk-averse mindset. They're less likely to compete with Progressive for the 22-year-old with 2 speeding tickets, and more likely to compete with State Farm for the 45-year-old suburban family. The key difference is that Allstate often leans into the idea of premium protection. They're the luxury sedan to State Farm's reliable family SUV. So if you're at a point in your life where your primary concern is asset protection, and you believe you get what you pay for, then you are speaking Allstate's language. You fit the profile of someone they are willing to invest in because they know you value the security they're selling. Understanding these appetites is like having a cheat code. When you get a quote, you're not just a faceless driver. You are a collection of data points that either screams perfect match or next to a company's algorithm. If you have a pristine record and great credit, Geico is probably going to offer you a fantastic rate. If you have a minor fender bender and want a slick mobile app, Progressive will likely be your best bet. If you own a home and want a local relationship, State Farm is waving you over. By knowing who they're looking for, you can stop wasting your time with companies that were never going to give you a good deal in the first place. You can focus your energy on the ones whose machines are programmed to see you as the perfect, most profitable customer. But here's the thing. We've only talked about the giants, the big four you see on TV every 10 minutes. They cast the widest nets, but their appetites, while huge, are still relatively broad. What if you don't fit neatly into any of these boxes? What if you're a special case? What if you own a classic car? Or you're an active duty service member? Or a member of a specific credit union? The giants might give you a decent rate, but they aren't specialists. There is a whole other world of insurance out there. A hidden ecosystem of companies with hyper-specific, laser-focused appetites. Companies that only insure veterans. Companies that only insure low-mileage drivers. Companies that exist only for the members of a single profession. These are the niche players, and for the right person they can offer deals that the big guys simply cannot afford to match. And in the next part, we are going to venture into this secret world and reveal the specialist insurers who could save you an absolute fortune. Think of the auto insurance market like a clothing store. The big names, your Geicos, Progressives, State Farms, they're the giant department stores. They have something for almost everyone, rows and rows of off-the-rack options. And for a lot of people that's perfectly fine. But what if you're not an average size? What if you need a suit tailored for a specific, unique occasion? You wouldn't go to the department store. You'd go to a specialist. A bespoke tailor who understands your exact needs, who uses materials and techniques the big stores don't. This is the secret world of specialist auto insurance. These companies don't waste millions on Super Bowl ads. They don't try to be everything to everyone. Instead, they focus with laser-like precision on one type of driver, and they serve that driver better than anyone else on the planet. Let's start with a group of people for whom a car isn't just a car. It's a passion, a piece of history, a work of art. I'm talking about the classic and collector car owner. If you own a 1969 Camaro SS, a vintage Porsche 911, or even a meticulously restored DeLorean, and you try to insure it with a standard company, you're in for a world of pain. They'll look up the book value and see a 50-year-old car, offering you a policy that would barely cover the cost of your custom wheels, let alone the tens of thousands you've invested in restoration. They just don't get it. They see an old liability. You see a priceless heirloom. This is where a company like Hagerty or Grundy Worldwide comes in. These aren't just insurance companies. They are institutions built by and for car enthusiasts. They understand the difference between actual cash value and agreed value. An agreed value policy is the holy grail for collectors. You and the insurer agree on the car's value up front. Say, $80,000 for your pristine Camaro. If the worst happens and it's a total loss, they write you a check for $80,000. Period. No arguments, no depreciation. They also understand how you use the car. They know you're not daily driving it to the office in a snowstorm. Their policies are built around limited, pleasure-use mileage, car shows, and club events, which dramatically lowers the risk and therefore the premium. They offer specialized coverage for spare parts, for tools, even roadside assistance with flatbeds guaranteed to handle low-clearance vehicles. Trying to get this level of understanding from a standard call center is impossible. With a specialist like Hagerty, you're not just a policy number. You are a fellow custodian of automotive history. For this type of driver, they aren't just the most reliable option. They are the only option. Now let's talk about another group. A group defined not by the car they drive, but by the service they give. I'm talking about the members of the United States military and their families. Their lives are anything but standard. They face challenges the average civilian can't imagine, frequent relocations, often with little notice, deployments overseas where a car might be in storage for a year, and the complexities of being stationed in different states or even countries, each with its own insurance laws. A standard insurer struggles with this. They see a move from Texas to California as a new policy, a new risk assessment, a mountain of paperwork. They see a car in storage as a confusing liability. But there is one company that was created for this exact purpose. Its name is USAA, the United Services Automobile Association. And if you are eligible to join, you need to pay very close attention. USAA was founded in 1922 by a group of 25 Army officers who couldn't get auto insurance because, as military personnel, they were considered a high-risk group. So they decided to insure each other. That foundational principle, of service members taking care of their own, is baked into the company's DNA. USAA is not a publicly traded company with shareholders to please. It's a member-owned association. This means its profits are returned to the members in the form of dividends, lower premiums, and what is consistently ranked as the single best customer service experience in the entire industry, across any category. They understand military life. Need to store your car during deployment? They have massive discounts and specific policies for that. Moving to a new base? They handle the transfer seamlessly. They even offer accident forgiveness and other perks that are hard to come by. Their financial stability is rock solid, and their claims process is legendary for its speed and fairness. For the millions of active duty members, veterans, and their families who qualify, USAA isn't just a good choice. It's a cherished benefit earned through service to the country. It is the definition of reliability for a community that deserves nothing less. But what if you're on the other end of the spectrum? What if, through some bad luck or bad choices, the insurance industry has labeled you as high risk? Maybe you have a DUI on your record. Maybe a few at-fault accidents. Maybe your credit score has taken a hit. When you go to the mainstream carriers, you either get an outright rejection or a quote so astronomically high it feels like a punishment. You need to drive to work, to live your life, but the system is making it almost impossible. You might need something called an State Route 22 form, a certificate of financial responsibility that the state requires you to have on file. Most standard insurers don't want to deal with the hassle. This is where another type of specialist shines. Companies like the General, Safe Auto, or Dairyland weren't created for pristine classics or military heroes. They were created for the everyday person who needs a second chance. Their specialty is navigating the complex world of high-risk insurance. They are experts in filing SR22s and getting drivers legally back on the road. Now let's be clear. Their premiums will be higher than someone with a perfect record. That's the nature of the risk they're taking on, but they will often be significantly lower than the quotes you'd get from a standard carrier who doesn't even want your business. More importantly, they provide a path. They provide a service that allows someone to get back on their feet, to drive to their job, to prove they can be a responsible driver again. After a few years of safe driving, you can often graduate back to a standard insurer. So, is a company like the General reliable? In this context, absolutely. They are reliable at doing exactly what they promise, providing coverage for those who can't get it elsewhere, and doing so efficiently. They are a lifeline, and for millions of Americans, that is the most valuable kind of reliability there is. Finally, let's shift from your driving record to your driving habits. The world has changed. More people work from home. More people live in dense urban areas where they walk, bike, or use public transit, only using their car for weekend trips or grocery runs. Yet for decades, insurance was priced on a one-size-fits-all model. A person driving 3,000 miles a year was often paying a similar premium to a supercommuter driving 20,000 miles a year. It just didn't make sense. This is the problem a new breed of tech-focused specialists set out to solve: the pay-per-mile or usage-based insurer. The pioneer in this space is a company called Metromile, with others like Nobler and Mile Auto now competing. The concept is brilliantly simple. You pay a low flat monthly base rate and then a few cents for every mile you actually drive. How do they track it? With a small device you plug into your car's diagnostic port or through your smartphone sensors. If you have a month where you barely use your car, your bill is tiny. If you go on a long road trip, your bill will be higher, but it's directly and fairly tied to your usage. This model is a game changer for retirees, city dwellers, students, and the millions of people in the remote work economy. It fundamentally realigns the cost of insurance with the actual risk of you being on the road. For these low-mileage drivers, the reliability of a company like Metromile isn't just about paying claims. It's about the reliability of a fair price. It's about a system that finally recognizes their lifestyle and rewards them for it, potentially cutting their insurance bill in half. From the weekend warrior polishing their classic Mustang, to the soldier preparing for deployment, to the driver rebuilding their record, to the remote worker whose car sits in the garage all week, there is a specialist insurer out there. They operate in the shadows of the giants, offering a tailored, focused, and often more reliable experience for those who don't fit the standard mold. Finding them is the key to unlocking a level of service and savings the big companies can't touch. But knowing they exist is only half the battle. How do you actually compare them? And how do you use their existence to get a better deal from the big guys? That requires a strategy. And that strategy begins not with a phone call but with a folder. Before you even think about getting a single quote, you need to arm yourself with information. This is the single biggest mistake people make. They jump into the quote process unprepared, fumbling for information, and getting inconsistent quotes because they're providing inconsistent data. We're not going to do that. You're going to build your insurance dossier. First, you need the basics for every vehicle you want to insure: the year, make, model, and most importantly, the VIN, the vehicle identification number. This is the car's fingerprint. It tells the insurer everything from its safety features to its engine size. Have it ready. Next, collect the driver's license numbers for every person in your household who will be on the policy. You'll also need their dates of birth and a rough idea of their driving history. Any accidents or tickets in the last 3 to 5 years. Be honest here. They're going to run a report and find out anyway, and it's better to have your quotes be accurate from the start. Finally, and this is the crucial part, grab your current insurance policy's declarations page. This is the summary of your coverage. This single document is your Rosetta Stone. It lists your exact liability limits, your deductibles for comprehensive and collision, and any extras you're paying for, like rental car reimbursement or roadside assistance. You must have this. Why? Because our goal is to get an apples-to-apples comparison. We're not just looking for a cheaper price, we're looking for a better value. And you can't know if it's a better value unless you're comparing the exact same level of protection. Once your dossier is complete, it's time to enter the quote gauntlet. Your mission is to gather a minimum of 5 quotes. This is non-negotiable. Getting 1 or 2 quotes is like asking only 1 or 2 people for directions. You might get lucky, but you could also end up completely lost. We need data. Specifically, you're going to get 3 quotes from the national giants, the ones you see on TV every 10 minutes. Then, you're going to get 2 quotes from those regional champions or mutual companies we talked about in the last part. Use an online search for best-rated regional auto insurance in your state to find them. This 3-to-2 split gives you a baseline from the big players while simultaneously testing the waters with the smaller, often more competitive companies. Now, as you get these quotes, you will use your declarations page to request the exact same coverage from every single company. If you have 100/300/100 liability coverage now, you ask for 100/300/100 from everyone else. If you have a $500 collision deductible, you ask for a $500 collision deductible. Do not let the agent or the online form nudge you into a lower coverage level just to show you a cheaper price. That's a classic bait and switch. They show you a shockingly low number, but they've secretly slashed your protection in half. We are standardizing the variable of coverage so that the only thing we're comparing at first is price and the company behind it. Once you have your 5 quotes lined up, all with identical coverage, you'll likely see a massive price range. It's not uncommon to see a difference of $1,000 or more for the exact same policy. This is the moment you realize how much money you've been leaving on the table by staying loyal to a single company without shopping around. But our work is far from over. A cheap price from an unreliable company isn't a good deal. It's a future disaster. Now we move to the most important phase, vetting the companies themselves. This is where we separate the contenders from the pretenders. We are going to use 3 powerful, publicly available tools that the pros use. The first is the J.D. Power U.S. Auto Insurance Study. J.D. Power is the gold standard for consumer satisfaction rankings. They poll tens of thousands of actual customers on everything from the initial shopping experience to the billing process and, most critically, the claims process. They then rank insurers by region. Look up your specific region of the country and see who is at the top of the list. A company with 5 out of 5 power circles in overall satisfaction and claims is a very strong signal. A company consistently at the bottom of the list is a major red flag, no matter how cheap their quote is. The second tool is a bit more of an industry secret, and it's incredibly powerful. It's the National Association of Insurance Commissioners, or NAIC Complaint Index. The NAIC is the regulatory body that sets standards for insurance in the U.S. They track every official complaint filed against an insurer by a consumer. They then compile this data into a simple complaint ratio. The national median ratio is always set to 1.0. So, a company with a complaint ratio of 2.0 has twice as many complaints as you'd expect for a company of its size. A company with a ratio of 0.5 has half as many. This is pure, unadulterated data on how often a company makes its customers angry enough to file a formal complaint. You want to look for companies with a ratio significantly below 1.0. This is one of the clearest indicators of a company that treats its customers fairly and handles claims smoothly. The third and final tool answers the most fundamental question of all. If you have a major claim, does this company actually have the money to pay it? For this, we turn to AM Best. AM Best is the credit rating agency for the insurance industry. For over a century, they have been analyzing the financial health and stability of insurance companies. They issue financial strength ratings just like a credit score for a person. You're looking for companies with a rating of A-, excellent, or higher. An A+ or A++ superior is the best you can get. A company with a high AM Best rating is a fortress. It has the capital reserves and financial discipline to withstand major catastrophes, economic downturns, and pay out even the largest of claims without breaking a sweat. Never ever sign a policy with a company that has a poor or mediocre AM Best rating. It's like putting your money in a bank you know is on the verge of collapse. So now your strategy is taking shape. You have your 5 apples to apples quotes. Next to each price, you've now added its J.D. Power ranking, its NAIC complaint ratio, and its AM Best financial strength rating. Suddenly, the picture becomes incredibly clear. That super cheap quote from Bargain Bin Insurance Incorporated might have a terrible complaint ratio and a shaky financial rating. Meanwhile, a regional mutual company might be slightly more expensive than the cheapest option, but it has top-tier customer satisfaction scores, almost no complaints, and an A++ financial rating. This is how you find true reliability. You're no longer just a price shopper. You're a risk analyst. You're looking at the complete picture. This comprehensive data set you've built is more than just a comparison tool. It's ammunition. It's leverage. Because the final step in this strategy isn't just to pick the best company from your list. It's to use this list to make the best deal even better. You are now in a position of power. You know the market inside and out. You know who is offering the best value, and you have the proof in your hands. So how do you take this powerful intelligence and use it to get your number one choice to lower their price, or to get your current company to match the competition and beg you to stay? That's not about luck. It's about a very specific negotiation technique. It's called the loyalty gambit, and it works because it flips the entire power dynamic. You see, insurance companies spend on average between $500 and $900 just to acquire a single new customer. That's their CAC, their customer acquisition cost. It's a massive expense. But keeping you an existing customer? That costs them next to nothing. It is monumentally cheaper for them to give you a discount than it is to lose you, and then spend a fortune trying to replace you. When you call them with a competitor's offer in hand, you are forcing them to make a simple business calculation. Is the cost of keeping this customer lower than the cost of losing them? And almost every single time, the answer is a resounding yes. They would rather make less money from you than zero money from you. The loyalty gambit weaponizes this economic reality. So here's how you execute it step by step. First, preparation is everything. You cannot go into this conversation unprepared. You need your competing quote printed out or saved on your screen. Not a vague idea of a quote, the actual official document from the other company. You need to know the premium down to the exact cent. And you need to have done a line-by-line comparison of the coverages. When they try to tell you, oh, but that other policy probably doesn't have rental car reimbursement, you need to be able to say, actually, it does. It has $35 a day for 30 days, just like my current policy. You must dismantle their objections before they can even voice them. Know your policy number, your renewal date, and how long you've been a customer. The longer you've been with them, the more powerful this gambit becomes. Second, you don't call the generic 1-800 customer service number on their website. That line is for paying bills and asking basic questions. The people who answer that phone often have zero authority to change your rate. You are going to call your insurance company, and when you get a person or an automated system, you are going to use one of two magic words: retention or cancellation. Say, I need to speak with someone about canceling my policy, or please connect me to your customer retention department. This is a signal flare. It sends you to a completely different type of employee. You'll be talking to a specialist whose entire job, whose entire bonus structure, is based on one single metric: preventing you from leaving. They have tools, discounts, and authority that the frontline reps can only dream of. Third, the script. This is the most important part. You are not calling to yell. You are not calling to complain or to make demands. Anger gets you nowhere. It makes them defensive. Instead, you are calling with a heavy heart. You are a loyal, happy customer who has been tragically forced into this position by a competitor's unbelievable offer. Your tone is one of reluctant disappointment. The conversation should go something like this. They'll answer, "This is Mark in retention, how can I help you?" And you'll say, "Hi Mark. My name is," your name, "and my policy number is," your number. I'm calling today for a really unfortunate reason. I've been a happy customer with you guys for 7 years, and I've honestly never had a single complaint. But my renewal is coming up, and the new premium is just a lot higher than I was expecting. So, just to do my due diligence, I got a few other quotes. And, well, another A-rated company offered me the exact same coverage, and I've checked it line by line for $450 less for the year. I really don't want to leave. You guys have always been great, but $450 is a lot of money for my family right now. So I'm calling to see if there is anything at all you can do before I make the switch. Let's break down the psychology of what you just did. You started by complimenting them. You established your loyalty and tenure. 7 years, never a complaint. This frames you as a valuable customer worth keeping. Then, you stated the problem clearly and unemotionally. You provided the exact specific number, $450 less. This shows you've done your homework. And crucially, you ended with a plea for help that gives them the power. Is there anything you can do? You've made it their choice to be the hero and save you, the loyal customer. You haven't demanded they match the price. You've simply presented the unfortunate facts and expressed your sincere desire to stay. At this point, the retention specialist goes to work. They will put you on hold. Don't be nervous. This is a good thing. They're not ignoring you. They are digging through their system, looking for every possible discount they can apply to your account. They're looking for loyalty discounts, claims-free discounts, multi-policy discounts that maybe you weren't getting. They're looking for discretionary adjustments that only their department can authorize. When they come back, one of 3 things will happen. Best case scenario, they match it or even beat it. They'll say, okay, I was able to apply a special long-term customer credit and a policy review discount. We can get your new premium down to match that offer. Can I go ahead and lock that in for you? And you've won. The second and more common scenario is they get close. They'll say, okay, the best I can do is get it down by $350. Now it's your turn to make a decision. Is saving that extra $100 worth the hassle of switching your billing, your ID cards, and learning a new company system? For many people, getting 80% of the way there is a huge win, and they'll accept the offer. You can even counter gently. Wow, that's much better, thank you. $350 is a huge help. Is there any chance you could do an even $400? If you can, I'll lock it in right now. Sometimes they have a little extra wiggle room. The third scenario is they say no. They might say, I'm sorry, but our rates are set by the underwriters and there's simply nothing I can do to match that. This is where your preparation pays off. If they try to question the competing offer's coverage, you calmly and politely walk them through the line-by-line comparison you already did. If they say it's an introductory teaser rate that will just go up next year, you can say, I understand that's a possibility, but a guaranteed $450 in savings this year is too much to pass up on a maybe. If they truly won't budge, you remain polite. Okay, Mark, I really appreciate you trying. I'm sorry it didn't work out. I'll need to go ahead and set my cancellation date for day before your policy renews. Sometimes, just beginning the actual cancellation process will trigger one final, last-ditch offer. If not, you thank them for their time and you switch, saving hundreds of dollars with your new company. You win either way. This gambit is designed for your current insurer. But what about that other scenario? What if your number one choice for reliability, let's call them Reliable Mutual, gave you a quote that was good but not the absolute lowest? Say a less reputable company, Bargain Bin Insurance, beat them by $200. You can run a modified version of this play. You call Reliable Mutual. Not their retention department, but their main sales or customer service line. You say, hi, I'm a new potential customer, and you've given me a quote that I'm very interested in. Your company's reputation is fantastic, and you're my first choice. The only thing holding me back is that I have a competing offer from another company for the exact same coverage that's $200 less. I know your rates are your rates, but I was wondering if you could just double check to see if there are any other discounts I might qualify for that we missed, like for my profession, or for having anti-lock brakes. I would much rather be with you guys if we can just narrow that gap a little bit. This is a softer approach, but it's surprisingly effective. You're not demanding they price match. You are signaling that you are a serious, informed buyer who wants to give them their business. You're making them a partner in solving the problem. More often than not, they will be happy to scrub your application again for any possible discount, and you might just find another 5 or 10% in savings, making your number one choice the obvious winner. You now hold all the cards. You have the data, you have the competing offers, And now you have the exact strategy and script to turn that leverage into hundreds of dollars in real savings. But what if I told you that even after you've negotiated the lowest possible price, there are still secret discounts, like hidden treasure, buried deep inside your policy that your insurance company is hoping you never, ever ask about? Unlocking them requires knowing the secret passwords. The first password isn't a word, it's a reevaluation. It's based on a fundamental shift in American life that has happened over the last few years, a shift that your insurance company is quietly profiting from. I'm talking about the death of the daily commute. Millions of Americans are now working from home, either full-time or in a hybrid model. Your car, which was once a road warrior racking up 15,000 miles a year, might now be a glorified garage ornament that only sees the light of day for grocery runs and weekend trips. Yet, you are very likely still paying a premium based on a commuter classification. Your rate is calculated as if you're still battling rush hour traffic 5 days a week. The secret isn't just to call and say, "I'm driving less." They'll knock a few bucks off. The secret password is to request a usage reclassification. You need to use that specific term. You call your agent and say, "I'd like to review my vehicle's official usage classification. My driving habits have permanently changed from commute to pleasure use." Pleasure use is the lowest risk category a vehicle can be in. It tells their algorithm that the car is no longer being used during the most dangerous, congested, and claim-heavy times of the day. This isn't a low-mileage discount, which is a small bonus. This is a fundamental reclassification of your risk profile, and it can slash your premium by a significant percentage, sometimes up to 15 or 20%, all because you used the right 2 words. The second secret password unlocks the power of the group. Most people know about alumni discounts or maybe a discount for being in the military. That's entry-level stuff. The real treasure is buried in the vast, interconnected web of affiliated group discounts that insurers have, and they will never, ever volunteer this information. We're talking about professional organizations like the American Bar Association or the National Association of Realtors. We're talking about your credit union. We're talking about wholesale clubs like Costco or Sam's Club. Even the company you work for might have a negotiated group rate that no one in HR ever told you about. The mistake people make is asking one by one, "Do you have a discount for this? Do you have a discount for that?" The agent just types it in, sees a no, and moves on. The secret password is to flip the script and make them do the work. You say this exact phrase, "Can you please run a full profile search for all available affiliated group and occupational discounts?" This phrase triggers a different kind of search in their system. It forces the agent to cross-reference your entire profile, your employer, your stated profession, the university you attended, against their master list of hundreds, sometimes thousands of partner organizations. I heard from a guy, an accountant, who saved an extra 12% because his insurer had a partnership with a niche national accounting society he'd been a member of for a decade. He never would have thought to ask about that specific group, but because he used the password, the system found it for him. That was over $200 a year back in his pocket. The third password is all about the technology hiding in plain sight inside your car. When you get a quote, they ask you if you have anti-lock brakes and airbags. That's like asking a restaurant if they serve water. It's the absolute baseline. But modern cars are packed with sophisticated safety systems, advanced driver assistance systems or ADAS, that actively prevent accidents. I'm talking about blind spot monitoring, lane keep assist, automatic emergency braking, adaptive cruise control, even factory-installed GPS tracking systems that can recover a stolen vehicle. Each one of these features makes you a statistically safer driver, and each one has a potential discount attached to it. The problem is, the VIN number lookup they use to identify your car often doesn't capture these specific features, especially if they were part of an optional package. The insurance company is rating your hyper-advanced, semi-autonomous car as if it's a basic model. You have to tell them, but again, don't just list them off. The secret password is to request a vehicle safety feature audit. You call them and say, "I believe my policy is missing several key safety feature discounts. I'd like to schedule a full vehicle safety feature audit to ensure my rate accurately reflects my car's capabilities." This formal-sounding request does 2 things. First, it signals that you are a serious, informed customer. Second, it often compels the agent to pull up a detailed, multi-point checklist they wouldn't normally use. You then go down the list with them, feature by feature. "Yes, I have forward collision warning. Yes, I have rear cross-traffic alert. Check, check, check." Each yes is like another snowflake. Alone it's not much. But when they all pile up, the cumulative discount can be massive. Now for the fourth password. This one is my favorite because it's so beautifully counterintuitive. It's called the loyalty penalty reversal. For decades, we've been taught that loyalty to a company is a virtue that gets rewarded. With car insurance, the opposite is often true. Insurance companies use a sinister practice called price optimization. They use complex algorithms to figure out which customers are least likely to shop around for a new policy. And who are the least likely to shop around? Their most loyal long-term customers. So year after year, they slowly, almost imperceptibly, raise your rates. A practice known as rate creep. They're betting on your inertia. They're penalizing you for your loyalty. You might be paying hundreds of dollars more than a brand new customer for the exact same coverage. It's infuriating. So how do you reverse it? You can't just call and complain. You need the password. When your policy is up for renewal, you call them and you say these magic words. Hi, I'm calling because my renewal is coming up. Before I finalize my decision, I'm gathering competitive quotes and I need to know what my rate would be if I were a brand new customer signing up with you today. This phrase is a tactical nuke. It instantly changes your status in their system from loyal, complacent cash cow to high-risk flight threat. In most cases, this will get you transferred to the retention department. These are the specialists who have the authority to do what normal agents can't. They can strip away all those years of loyalty penalty increases and offer you the highly discounted introductory rate. They can effectively turn back the clock, giving you the price you should have been paying all along. All because you signaled that you know the game and you're not afraid to walk away. The fifth and final secret password for today reframes a discount you think you know into a penalty you didn't realize you were paying. I'm talking about the pay in full discount. Most people know that if you pay your entire 6-month or 12-month premium upfront, you get a small discount. What most people don't know is how much the alternative is truly costing them. The insurance company loves it when you pay monthly. Why? Because they get to charge you. They charge you installment fees, administrative fees, processing fees, a whole host of little charges that are baked into your monthly payment. The secret isn't to ask, how much do I save by paying in full? They'll give you a small, unimpressive percentage. The secret password is to ask this question instead. Can you please tell me the total dollar amount of all administrative and installment fees I am paying over the course of my 12-month policy by choosing the monthly payment plan? This forces them to stop talking about the tiny discount and start talking about the giant penalty. When the agent comes back and says, well, it looks like you're paying $8 a month in fees. That doesn't sound like much. But then you do the math, that's $96 a year. $96 you are paying them for the privilege of giving them their own money in smaller chunks. Suddenly, paying in full isn't about getting a measly 5% discount. It's about avoiding a guaranteed $96 loss. It reframes the decision in your mind from a small gain to a significant, unnecessary expense you can eliminate with one single payment. You're not just saving money, you're stopping the bleeding. By using these 5 secret passwords, you can systematically dismantle the hidden profit centers in your policy and reclaim hundreds, maybe even thousands of dollars. But here's the crucial, final piece of the puzzle. A cheap policy from a company that will fight you tooth and nail when you file a claim is worse than worthless. It's a trap. All this work we've done to lower the price means nothing if the company itself is unreliable. So how do we find the truth? How do we look past the funny commercials and the slick marketing to see which companies actually have a culture of paying claims quickly and fairly, and which ones have a secret internal playbook designed to deny, delay, and defend? How do we find the data that companies pray you never see? That's where we're going next. We're about to uncover the most important metric of all. It's called the Complaint Index. And it's not a survey. It's not an opinion poll. It's a cold, hard mathematical calculation of corporate behavior, tracked by the one organization every insurance company in America answers to: the National Association of Insurance Commissioners, or NAIC. This isn't a private company like J.D. Power. This is the state-level government regulatory body. Every single time a consumer feels so wronged, so ignored, so cheated by their insurance company that they file a formal complaint with their state's Department of Insurance, the NAIC records it. They track complaints about everything: false advertising, underwriting issues, policy service. But the one we care about, the one that cuts to the very heart of reliability, is claims. Unfairly denied claims, unreasonably delayed payments, lowball settlement offers. This is the official record of frustration. It's the data point generated when a company's promise is broken. The NAIC then takes all this data and performs a simple but brilliant calculation. They compare the number of complaints a company receives to its size in the market. This is crucial. Of course, a company with 30 million customers will have more complaints than one with 300,000. The complaint index adjusts for this. It creates a level playing field, giving us a score that represents a company's complaint-to-customer ratio. The national average for all companies is set at 1.0. It's the baseline. If a company has a complaint index of 1.0, it means they get exactly the number of complaints you'd expect for a company of their size. If their score is below 1.0, say 0.5, it means they get only half the number of expected complaints. That's a sign of a company doing things right. But if their score is above 1.0, say 2.0, it means they are generating twice the number of complaints as their peers. A score of 3.0? 3 times. This isn't a small statistical variance. It's a massive red flag. It is the numerical proof of a company culture that has embraced the deny, delay, defend playbook we talked about. This isn't a measure of how good their Super Bowl commercial was. It's a measure of their integrity when your life has been turned upside down. So, forget the marketing slogans for a minute. Let's look at the numbers they can't hide. We're going to look at the Private Passenger Auto Complaint Index for some of the biggest carriers in the nation. The numbers I'm using are based on the most recent publicly available data from the NAIC. Let's start with the benchmark for excellence. A company that consistently sets the standard for keeping its customers happy, even after a claim. USAA. Now, I know not everyone is eligible for USAA, as it's primarily for military members and their families, but we need to see what's possible. USAA's auto complaint index typically hovers around 0.38. Let me repeat that. 0.38. That is stunningly low. It means they receive less than half the number of complaints expected for an insurer of their massive size. This is what it looks like when a company's core mission is to actually serve its members, not just its shareholders. They are the gold standard. Now let's look at some of the companies that are available to everyone. How do they stack up? Let's take Amica Mutual, often praised for customer service, and the data backs it up. Their complaint index is also incredibly low, often coming in around 0.45. Again, less than half the national average. This tells you that the friendly service you get when you sign up isn't a facade. It extends to the claims department. What about the giants? The ones you see on every street corner and TV commercial? Let's look at State Farm. As one of the largest insurers in the country, you might expect them to have a higher index just due to sheer volume. But their complaint index is consistently below the average, often around 0.65. This is very impressive for a company of their scale. It shows that despite their size, they have systems in place that, for the most part, handle claims in a way that doesn't drive their customers to file formal complaints with the state. They are a reliable, better-than-average choice according to this critical metric. Geico, another behemoth. Where do they land? Their index is usually right around the national average. Sometimes a little below, sometimes a little above, but often hovering very close to that 1.0 mark. This means you're getting an average experience. They aren't generating an alarming number of complaints for their size, but they aren't a standout performer like USAA or Amica either. It's a perfectly middle-of-the-road result. But now, let's look at the other side of the coin. The companies whose numbers start to tell a different story. Take Progressive, another massive player in the industry. Their complaint index is frequently above the 1.0 average. It's not uncommon to see it sitting around 1.25 or 1.3. This means they are generating 25 to 30% more complaints than you'd expect for a company of their size. This is a statistically significant signal. It suggests a higher likelihood of running into friction, delays, or unsatisfactory offers when you file a claim compared to a company like State Farm. And then we move into more concerning territory. Let's talk about Allstate. Despite their good hands marketing, their complaint index has often been significantly higher than many of their top competitors. It has frequently been documented at 1.5 and, in some years, even higher. A score of 1.5 means they are generating 50% more complaints than they should for their market share. This isn't a fluke. It's a pattern. It points to systemic issues in their claims process that leave a large number of their own customers feeling like they had no other choice but to seek regulatory help. But it gets worse. Let's look at a company like Liberty Mutual, another household name. Their complaint index for auto insurance has, at times, soared past 2.0. Let that sink in. Double the national average of complaints. For every 1 complaint State Farm gets relative to its size, Liberty Mutual is getting 3. This is a 5-alarm fire. A number this high suggests that the deny, delay, defend strategy may not be a last resort, but a standard operating procedure. It indicates a fundamental disconnect between the promise they sell and the product they deliver when it matters most. And there are others. Many smaller, non-standard insurance companies that specifically target high-risk drivers often have astronomical complaint indexes, sometimes reaching 5.0, 10.0, or even higher. They build their business model on collecting premiums and fighting claims tooth and nail, knowing their customers often have fewer resources to fight back. So why is this one number, this complaint index, more important than all the others? Because it's the ultimate lie detector. An insurance company can buy commercials, they can train their sales agents to be friendly, they can design a slick app, and they can pay a marketing firm to get them on a best of list. But they cannot fake this number. This number is the unfiltered voice of the customer at their worst moment. It is the final objective verdict on a company's character. A low premium is a siren song that can lure you onto the rocks of a nightmare claims process. A high score in a customer satisfaction survey might just mean people like the company's website, not that they've ever had to file a major claim. The complaint index bypasses all of that noise. It answers the one question that truly matters. When I am at my most vulnerable, when I have been in an accident and I need the protection I paid for, will my insurance company have my back? Or will they see me as a cost to be managed? We now have the final crucial piece of the puzzle. We've analyzed price. We've broken down coverage and discounts. We've looked at customer service and financial strength. And now, we've pulled back the curtain on the single most powerful indicator of a company's true reliability. We have the data they pray you never look up. We know who the saints are, who the sinners are, and who's just average. The only thing left to do is put it all together. To weigh the cost against the coverage, the service against the all-important complaint index, and to render a final verdict. In the final part of this series, we will build the definitive list. We will name the single most reliable auto insurance company in America, and we will give you our top-tier recommendations for every type of driver. The final answer is just ahead. So, after weeks of data analysis, thousands of customer reviews, and a deep dive into the financial skeletons of every major insurer, the moment of truth has arrived. We set out to find the single most reliable auto insurance company in America. Not the cheapest, not the one with the funniest commercials, the one you can truly count on when things go wrong. To do this, we built our judgment on 4 unbreakable pillars. First, financial stability. Does the company have the cash to pay out claims, even in a catastrophe? Second, customer satisfaction, breaking it down into both the day-to-day service experience and the nightmare scenario, the claims process. Third, pricing and value, not just the lowest number, but honest pricing without constant, inexplicable hikes. And finally, technology and convenience. How easy is it to manage your policy, file a claim, and get help in the digital age? Now, before we crown our champion, it's crucial to acknowledge the runners-up. Companies that excel in specific areas and might just be the perfect fit for some of you. Let's talk about Progressive. If you are a tech-savvy driver who loves to control every aspect of your policy from your phone, and you're willing to let them monitor your driving habits with Snapshot for a serious discount, Progressive is a force to be reckoned with. Their app is a benchmark for the industry, and their rate quoting tools are incredibly transparent. They didn't make our top 3 because their customer service ratings can be inconsistent, but for pure technological prowess and discount opportunities, they are a top contender. Then there's Geico. For decades, their mission has been simple: save you money. And for many, they deliver. They are often one of the most affordable options, especially for drivers with clean records. Their online experience is simple and streamlined. Where do they fall short of the top tier? While their claims process is efficient, the customer satisfaction scores from J.D. Power and Consumer Reports don't reach the heights of our finalists. They're good, but not consistently great. If your number 1, 2, and 3 priorities are all about price, Geico must be on your list to quote. With those honorable mentions out of the way, let's get to the podium. The bronze medal, our number 3 most reliable auto insurance company in America, is State Farm. There's a reason they are the largest auto insurer in the country. It's not just marketing, it's consistency. State Farm's power lies in its massive network of local agents. In an increasingly digital world, having a real person in your town who you can sit down with is an invaluable asset for many. Their financial strength is rock solid, and their claims satisfaction scores are consistently above the industry average. They aren't the cheapest, and their app isn't as slick as Progressive's, but they represent a gold standard of traditional, reliable insurance. For those who want to bundle home and auto and prefer a personal relationship over a login screen, State Farm is an elite choice. Taking the silver medal, our number 2 pick is Amica Mutual. Many of you may have never even heard of Amica, and that's because they don't spend $1 billion on advertising. They spend it on their customers. Amica has dominated customer satisfaction surveys for years. They are the company people rave about. When you call Amica, you get a knowledgeable, empathetic human being. When you file a claim, you're treated with respect. It's a level of service that feels like it's from a bygone era. So why aren't they number 1? 2 reasons. First, that premium service often comes with a premium price tag. They are frequently more expensive than the competition. Second, they are a mutual company, which means they can be more selective about who they insure. If you have a spotty driving record, you may not be able to get a policy. But if you have a great record and are willing to pay a bit more for the absolute best service in the business, Amica is, without question, your answer. And now the moment we've all been waiting for. The number 1 most reliable auto insurance company in America. This comes with a very important asterisk, so listen closely. Based on every single metric, claims satisfaction, customer service, price, financial stability, the undisputed champion is USAA. The data is overwhelming. J.D. Power consistently ranks them at the top in nearly every region of the country. Consumer Reports members give them near-perfect scores. Their customers are not just clients. They are advocates, displaying a level of loyalty unheard of in the insurance industry. They offer incredibly competitive rates, top-tier digital tools, and a claims process that is consistently rated as the best, bar none. But here is that asterisk. USAA is not available to everyone. It is restricted to current and former members of the U.S. military and their direct family members. If you are eligible for USAA, our advice is simple. Stop your search and sign up. The debate is over for you. You have access to the best insurance product in the country. So, for the 90% of the country that is not eligible for USAA, who is the champion? Who is the most reliable, publicly available auto insurer in America? Our number 1 pick is Auto Owners Insurance. Like Amica, Auto Owners is a name that might not be on your radar. They operate through a network of independent agents and are not available in every single state. But where they are available, they are exceptional. They have quietly built a reputation for outstanding service that rivals the very best. In the all-important J.D. Power Claims Satisfaction Study, they consistently score at the very top, often beating every major national brand. They balance this incredible service with pricing that is surprisingly competitive. They have an A+ financial strength rating, meaning they have the resources to be there for you. They combine the local expert knowledge of an independent agent with the power and reliability of a major national carrier. They are the total package. So Auto Owners is our overall champion. But we promise to give you the best option for your specific situation. Let's break it down. For young drivers and students, your main concern is price. Your best bets are Geico and Progressive. Use their online tools, play with the discount options, and see which one gives you the most tolerable rate. For military families, as we said, it's USAA. It's not even a competition. It's a benefit you've earned, and you should absolutely take advantage of it. For drivers with a less-than-perfect record, if you have a DUI, multiple accidents, or major tickets, the big names might turn you away or charge an astronomical rate. This is where you look at companies like the General or other insurers that specialize in non-standard or high-risk policies. The key here is to get coverage, drive safely, and rebuild your record so you can qualify for better rates in the future. For those who value customer service above all else, if the thought of arguing with a claims adjuster makes you sick, and you're willing to pay for peace of mind, the answer is Amica Mutual. You are paying for a premium concierge-level experience, and they deliver. For people who want to bundle home, auto, and more, State Farm and Allstate are the kings of bundling. Their agent-based model is designed to handle your entire insurance portfolio, and the discounts for doing so can be significant, making them a great value proposition. And finally, for the average American driver with a good record, who wants the best all-around blend of fair price, fantastic claims service, and financial reliability, our top pick, Auto Owners Insurance, is where you should start your search. If they're not in your state, our number 3 pick, State Farm, is your next best bet for a well-rounded, reliable experience. We started this journey to find a single name, but the truth is, the most reliable auto insurance company is the one that best fits your life. It's a balance of cost, coverage, and confidence. Your mission now is not to just blindly pick our winner. It's to take this knowledge and become a smarter shopper. Get at least 3 quotes. One from a tech-focused company like Progressive, one from a traditional giant like State Farm, and one from a service-focused leader like Amica or Auto Owners if you can. Compare not just the prices but the feeling you get from each company. Read the fine print. Understand your coverage. Because at the end of the day, auto insurance isn't just a legal requirement. It's a promise. It's a promise that if the worst day of your life happens on the road, someone will be there to help you pick up the pieces. Your job is to find the company that you trust most to keep that promise. Don't just shop for a policy. Shop for an ally.